That was quite a quarter, filled with government decision-making that makes you shake your head. Major disruptions to energy costs and future direction of central bank policy across the globe has been thrown into chaos. There are many trends in the financial markets that have been flipped on their head. We know that President Trump is very transactional and short-term in his thinking. This form of thinking has been adopted by a lot of investors. The result is investors react to every comment and rumor, leading to increased intraday and daily volatility. And in many cases, investors are getting whipsawed, hurting returns. More importantly, investors are missing long-term implications of these changes. Don't get me wrong, short-term movements in the markets and the economy are important. Most of the success investing is a result of blending both short-term and, more importantly, long-term views. This is a good time to review how we think about the financial markets, the economy, and how we construct portfolios. More than ever, it is important for investing success to prepare ahead of these events or changes in the world. We do that by creating scenarios of potential events or market activities. We use different programs to test the impact of these various scenarios on client portfolios. We create a forward look at both potential downturn and potential upside. Our investment committee has actually become very creative in thinking about potential events, and we add new ones every month. We then use the output to see vulnerabilities and opportunities. We adjust portfolios as the probability of these events increases. Our recent changes were a result of testing increased wars, energy disruptions, global recession, tariffs, inflation, and stagflation, to name a few. This keeps us from being too reactionary and enhances the stability of returns. Let's jump into the review of the performance so far this year. Markets closed out an undeniably volatile quarter. The scale and duration of the ongoing Middle East conflict caught investors off guard, driving violent and at times puzzling moves across a number of asset classes. However, the details about the first quarter performance show a different picture than what is commonly believed to have occurred in the markets. The first 2 months of the year, the markets were humming along on hopes of declining inflation, increased corporate earnings, and the Federal Reserve cutting short-term interest rates. Then, we all had a geography lesson on the Strait of Hormuz, and the downward trend hit the markets quickly. U.S. stocks as a whole, and especially tech sectors, had the most pain. Even U.S. Treasury instruments have failed to offer much risk-off support, given the rise to inflation threats. The good news for our portfolios was that we benefited from the dispersion in returns that enabled portfolio positioning to limit the volatility and the downside risks. The war in Iran is another in a line of policies that is reshaping the global economy and the financial markets. We see these changes have permanence to them. Some things are happening right away, but there are others that are just beginning and will reshape the opportunity set in investing. We are preparing ahead of these changes to stabilize investment returns through periods of uncertainty. Inflation expectations have shifted significantly since the start of the war. U.S. consumers and investor expectations now predict the highest inflation rate in over 7 months. We would not be surprised to see inflation get up to 3.5% this summer, because the effects of the war in Iran will carry on well after the conflict ends. This can directly impact economic growth as consumers pull back on spending to compensate for higher prices. Even before the war, we saw increased pressure on higher prices in 2026. It's why we have added further inflation hedging approaches to portfolios. Central bank policy is another area where we've seen dramatic shifts in expectations since the war began. Prior to the war, the markets were pricing in 2 quarter-point cuts by year-end, with the only question was whether a third cut would follow. The war erased those expectations and even increased the odds of a rate hike in 2026. With energy costs surging, the inflation potential is being priced into short-term interest rates. Keep in mind, though, these expectations can change anytime. Our base case is the Fed does 1/4 point rate cut late this year. The other thing, which is really important, is that we expect intermediate and long-term interest rates to stay stuck at higher levels. You can see evidence as mortgage rates have steadily climbed prior to and during the war. Many people are wondering why the financial markets have not fallen as much as expected. A big reason is the corporate earnings picture. Don't forget, 2026 is the first year of the impact of large tax cuts for corporations that were voted in last year. Corporate earnings growth is a big driver of stock market performance. As the chart on the left shows, forecasted earnings in the U.S. over the next few years shows healthy, steady growth. Profit margins have been and continue to be a larger contributor versus revenue growth. Companies outside the U.S. are showing very good earnings forecasts as well. And as you can see on the chart on the right, corporate profit margins are at very high levels. This also highlights a scenario we have been studying. If the war drags on, how badly could corporate earnings be hurt? It's why we have a quality tilt in our stock market positioning. That means screening for profitable companies that have investment-grade ratings, positive cash flows, and pay dividends. There is a dramatic shift across the globe. It has shifted country by country behavior to develop self-sufficiency and self-reliance at a rapid pace. This is leading to a revolutionary change in infrastructure spending. The war in Iran only adds to the trend. Beyond the widely known energy infrastructure needs, there are other megatrends that create a need for wider global infrastructure improvements and changes. Number one, urbanization and aging demographics and growing urban populations creates needs for water treatment, waste management, and communications. Number two, aging infrastructure. Many countries, including the U.S., which gets a C+ rating, have poor infrastructure ratings. Modernizing grids, roads, and bridges, etc., is a multi-decade cycle. And three, digital risk protection needs are ever expanding. Governments, utilities, and private enterprises are prioritizing investments that protect essential systems from cyber disruption. We are expanding our allocation in these areas as a result. Not only does this area offer opportunity, but it has also been a defensive and an income play. I mentioned the increase and changing dynamics of market volatility and our concerns with inflationary risks. We use hedging strategies to address these issues. The other goal for this approach is to reduce downside risk, lower volatility. Unlike bonds, they can perform in up markets, and they are very good income source. They are part of our non-stock allocation. We are adding hedging approaches with exposure across the U.S. and international markets. It is a challenging time for all of us, and the financial markets continue to bounce up and down as a result. We have a systematic approach to managing portfolios that has improved outcomes even when uncertainty is high. Please reach out to us if you have any questions or if we can help in any way.